Welcome to this episode of Property Banter. You can't buy your own house? Well, we think you can, and today we're going to break it down for everyone out there, all of the schemes and strategies available to first home buyers. Today we are joined by Scott Beattie from Cube Home Loans. Scott's been in the industry for 35 years. Cube Home Loans has been around helping people get into their first home for 20 years now, and they've won Best Brokerage 5 times. Welcome, Scott.
Thank you very much for that welcome.
Is that good enough?
Oh, fabulous. I'll take it.
Thank you, sir. Thank you, sir. My podcasting skills aren't always the best. I try. Just because I've got a podcast studio doesn't make me a podcaster. But, mate, thank you so much for joining us. We have a lot to cover. We've got a lot to cover in regards to all of the guarantees, government supports, concessions, strategies. We're going to be breaking it down for all first home buyers out there now that think they can't get into their first home. We're going to show them all the things that they need to do and all the things that are available to them to get them into their first home today.
100%. So we meet with a lot of first home buyers, and even though I've been around a little while, it's still my favourite market. It's really personally satisfying to help someone enter their first home, especially if they've been told no. And the scary thing is a lot of people are a lot closer than they realise.
Yeah. You don't know. You don't know what you don't know, right?
100%.
Let's talk about what's available, what government schemes, concessions and things are available. And because we're in Queensland, let's talk about Queensland in particular. Sure. What's available? Obviously, we do have a first homeowners grant, which everyone's heard of and everyone knows about. Let's break that down for everyone at home.
Absolutely. So when I meet with first home buyers, that's a really common question. Do you know what you can access? And they're like, oh, don't I get some money or something? Sometimes. So basically, if you purchase a brand new home for less than $750,000, you will get $30,000. As a rule of thumb, you've got to be the first person to sleep in it. So that can be you're purchasing land and then building, or you're buying a brand new home or unit, and as a rule, no one has slept in it, and it must be less than $750,000. It's not income cap, so you could be a millionaire, you would still qualify for that $30,000. In short, it's designed to get people building houses, which will hopefully reduce the housing crisis we've got at present.
Yep. The problem is there isn't, from a buyer's agent perspective, property investor, and we buy properties all the time, 749 doesn't give us a lot to work with.
100%. There's no
in Brisbane right now.
Yeah. So, and I guess sometimes you might have to go further out for a short period of time because you don't have to stay living in it forever. So, for example, you might say, well, look, I'm going to look out at Laidley or Greenbank, Jimboomba, places like that, Yarrabilba, perhaps, where you're below that price cap, and then you can access that scheme. You might stay living in it for 6, 12, 18 months.
So what's the requirement right now?
Great question. You must stay living in it for a minimum period of 6 months, and you must move in within the first 12 months.
So we must move in at some stage within the first 12 months from the settlement date or contract date?
From settlement.
From settlement date. So within 12 months, we're going to move in. So you can still rent it out for 6 months.
Correct.
And then move in technically.
Yeah, I've never had someone build a brand new house.
Sorry, I'm always looking for the technicalities, right?
Yeah, but I've never had someone build a brand new house and throw a tenant in there for 6 months.
No, that's true.
But theoretically, yes, you're right. As long as you move in prior to the next 12 months, provided that 12-month anniversary date, and you must stay there for a minimum of 6 months.
So 6 months.
And just be mindful too, there's some lender requirements around that as well. I'm not going to delve into that, but that's the scheme eligibility. You must move in within 12 months. You must stay there for 6 months. After that, 6 months, one day, you could move out. You're quite legitimately in the scheme parameters.
And you could turn that theoretically into a rental property you could just rent it out.
Spot on. Or if depending on the capital growth, obviously just be mindful you probably wouldn't want to sell it within 12 months because then there's some stamp duty payback. So just be mindful of those kind of parameters. Probably there wouldn't be enough capital growth in the first 12 months, I would think, to do so, but get advice if you're likely to do that because that could change where you end up purchasing and where a buyer's agent could come in handy.
Definitely. We don't like to sell even as buyer's agents from an investment perspective due to the tax implications. Obviously, within 12 months is never favourable whether you are a first home buyer or an investor. Anyway, let's jump on to first home concessions. Stamp duty savings up to $800K. Tell us about that.
Well, it's two parts. So firstly, if you're buying or building a brand new home, there's no stamp duty in Queensland. So you could be buying a house for $5 million, no stamp duty, providing you buying or building brand new. Obviously, I've always checked that with your conveyancer to ensure the eligibility, but yes. The other one is, however, if you're buying an existing home, there's a stamp duty exemption up to $700,000, and then it's on a sliding scale reduction from $700,000 to $800,000.
Okay.
Obviously, the closer to $700,000, the better the discount,
Yep.
and the closer to $800,000, the lesser the discount.
Yep.
Once you purchase $800,000 and above, you and I versus a first home buyer buying the house are paying identical in stamp duty.
Okay, so it's full stamp duty. So $800,000 or $801,000, it will be full stamps that you have to pay at whatever it's calculated by the Queensland government for an $800,000 property. Okay. First home guarantee. Tell us about the first home guarantee, where the government guarantee essentially replaces LMI savings of up to $12,000.
For sure. So LMI or lender's mortgage insurance is where if you don't have a 20% deposit, the bank literally insures your loan. As a borrower, you pay that one-off insurance premium. So the first home guarantee scheme, or the home guarantee scheme, was introduced during COVID to assist borrowers to enter the property market without having to pay that expensive one-off mortgage insurance premium. Quite a good scheme, big fan of it. There are some limitations to it though. Until January 1 in Queensland, there is a price cap of $700,000. There's an income cap for a single person of less than $125,000.
Yep.
Come January 1, assuming the federal legislation passes, and I believe it will, the price cap will be the average median price in Queensland or in every state, and the income cap will be removed. So arguably you could be a millionaire and you could still access that scheme, providing it's your first home.
Yeah. Tell us about the family home guarantee as well.
So the family home guarantee is similar to the first home guarantee. The first home guarantee is effectively where the government guarantees you, so you don't pay that one-off mortgage insurance premium. But sometimes you might be above the price cap. You may not be eligible for the scheme because of your income, because of the property location, the purchase price. You're not a first home buyer, perhaps. You can use what's called a parental guarantee. So typically,
the bank of mum and dad.
Bank, mum and dad. But the great part is they don't need to put their hand in their pocket to give cash. It's purely the bank taking a hold over mum and dad's house for the first 20% of the mortgage. So mum and dad are guaranteeing until I own the first 20% of my house, which
So it just has to go up 20% on top of what it was valued at by the bank and purchased at?
Spot on, and me paying the debt down.
Yes.
So
And
correct. So it doesn't have to be one or exclusive of the other. And hard to say in the current market, but we've been finding that's around a 2 to 3 year window. Once you own that 20%, mum and dad drop off, they no longer have any liability towards the property.
So their liability is the family home going up as a guarantee. So make sure during those 2 to 3 years, pay the loan.
Correct, but it's only a limited liability. So when I bought my first car and mum and dad went guarantor for me, my $16,000 for my Nissan Pulsar, it was all or nothing when they went guarantor. But in the current market, for easy figures, if you're buying a house for $100,000, mum and dad are only guarantoring the first $20,000 of the loan.
Okay.
So they're not, even if I didn't pay and the bank sold my house for $1, the maximum liability to mum and dad would be that 20% or $20,000 in that example.
Okay, fantastic. Good to know. Now, tell us what the difference is between help to buy, shared equity, and first home owner guarantee.
So the first home guarantee, there's the FHOG, the $30,000 if you're buying or building new. There's the mortgage insurance waiver where the government guarantees scheme. So the help to buy scheme, there's a state scheme in Queensland. There's also a federal scheme, obviously by the ALP government. Now they're both legislated. However, until a bank's on board, unless you're a cash buyer, unfortunately the schemes are useless. So for ease of figures, how we envisage it will work, and bear in mind it's not in play yet, so we don't quite know, but let's say you're buying a house for $100,000, the government can co-own up to 30% of your home. It is price capped and it is income capped, but again, until the lender's on board, it's kind of irrelevant.
So you're telling me that the government has created this initiative or this help to buy scheme, but none of the banks are willing to lend on it?
Not yet.
Not yet.
So, and that could be tomorrow, could be next week, could be next year. We don't know. The same as when the first home guarantee scheme with the mortgage insurance waiver came in, it was about 4 months before a lender came on board. So now there's 22 or 3 lenders who are on board with that scheme. So we don't know how quick that's going to be, whether it will be tomorrow or a year away.
It's quite funny though that they, I'm sidetracking now, but that they're very quick to brag about how well they've done and how they've helped homeowners. And it's great for publicity because I'm like, hey, that's really great. What a great job. Good work. And in reality, there's no lender lending on it. So technically, no one's accessing it.
There's no one that I'm aware of that could possibly. Well, if you're a cash buyer, there's no one that I'm aware of that you could possibly have used.
Good old government.
It is. It's a good start, but now until a lender's on board, unfortunately, in my opinion, the scheme is fairly useless. Okay.
Any talks of anyone joining that? Have you heard of anything? Not yet. So there's nothing in the pipeline. No. Okay, cool.
I couldn't say yes or no.
So let's just park the help to buy shared equity
Yep.
scheme. Leave that for now. But now, can someone use multiple grants or schemes together? Now, there's obviously a heap of them you mentioned on a state and a federal level. So there's a lot of people that, unless you're in the game, you need to talk to someone just to get clarity on your personal, not just your personal scenario and your position, but what there is available and whether you can layer some of them and maybe use 1, 2, or 3. Right? How does that work?
So there's absolutely no restriction in only using one or the other. So if you're eligible for every scheme, arguably you could potentially do that. So for example, you get the stamp duty concession because you're buying a property less than $700,000. If it was brand new, you'd also get the $30,000. And if you didn't have enough deposit, the 20% deposit, which let's face it is pretty well every first home buyer, you could also use the home guarantee scheme to avoid that one-off lender's mortgage insurance premium. So absolutely, you can use them and or all.
So definitely get in touch with yourself and you'd be able to.
Correct. And it's a matter
that.
of knowing what you can access and how it would benefit you, because you might think you can only go up to a certain amount, but now accessing more than one scheme enables you to potentially go a bit better than you thought. Or maybe you still might go, well, I know I can access that, but I'm still not going to. But at least you know what your options are.
Fantastic. Let's talk about HECS. Now, a lot of first home owners may have a HECS.
Yep.
A HECS on them?
Yes. Well,
the HECS debt. Talk to us about the HECS
so
debt.
firstly, the government renamed it HELP.
HELP, did they?
Rather than HECS, so it's now called HELP debt. Sounds better. Still the same thing. So there are some lenders coming in, they won't count HELP debt as a liability if you have less than 12 months to go.
Yep.
So that can be pretty beneficial if you've got a relatively small HELP debt, but it has a liability and it does reduce your borrowing capacity in most cases.
Yep.
Some lenders will allow you to pay it out. In some cases, it is better to pay it out to increase your borrowing capacity. I don't love recommending people paying out the HELP debt because it's a very low interest. Well, there's no interest. It's just purely indexed to inflation. Yep. So if you can avoid it, it's probably better to not pay it out, but sometimes it's the only choice to make the loan work with what you want to do.
To give you serviceability. Okay, so tell us in regards to the HECS debt, the HELP debt.
Yeah.
Tell us in regards to those lenders that don't apply it in servicing. Who would they be?
There's Commonwealth Bank is one of them, and basically, as I say, if there's less than 12 months to go, they will disregard it. So it's effectively will increase your borrowing capacity. The federal government that did retain government, they proposed that they would be disregarding HELP debt. We don't quite know if that's part of that at this stage or not, but for the moment, the Commonwealth Bank will potentially disregard the debt, providing there's less than 1 year to go on the repayment.
Yep, fantastic. In terms of lenders for the first home owners guarantee scheme, so FHOG, which lenders participate and which ones don't?
Okay, so just to clarify, the FHOG is for buying or building new. That's a state scheme. So pretty well every lender is an agent of the Office of State Revenue to process the grant on your behalf.
Right.
However, the home guarantee scheme, it's important to note that not all lenders participate in the scheme. Okay. We have access to 100 lenders. Realistically, we use 30 to 40 a reasonable amount of time. For example, Suncorp or ANZ aren't a scheme lender for the home guarantee. So if you walked into Suncorp or ANZ or called them, whatever, they're quite rightly going to offer you you'd hope, the best product they have available. But compared that to, say, NAB, Commonwealth Bank, Westpac, St. George, Great Southern Bank, there's a number of lenders, there's 30-odd that do it, you could have potentially saved that one-off mortgage insurance premium. Those premiums, $12,000 plus, I've seen them as high as $38,000. So if you can avoid paying that one-off mortgage insurance premium, obviously it's almost certainly going to be my advice, but just be mindful not all lenders are in the scheme and they have no obligation to tell you that, hey, we don't participate in the scheme. You may want to go and visit Westpac because they do. Then they're just not going to tell. Very unlikely they're going to tell you that.
Yes, of course. So a lot of people, and you touched on this earlier, and this is a great analogy, a lot of people will book a holiday in advance. So you will book overseas right now. Everyone's booking and going to Japan, right? Everyone now. You don't book those flights and go this week or buy or book today. You book them for 3 months in advance, 6 months in advance, and so on. Now, getting a loan for a property is the same. It's no different.
100%.
And you need to plan ahead and see a broker ahead of time so you can get yourself organised, essentially, right?
Correct. And it's a matter of mapping out a process that sits. And like travel, some people are ready to travel a lot quicker than they think. Some people are miles off, and either is okay, but you need to know how do you get to your destination. So for us, we're a free service broker. What we do is we map out that plan. Now, if that means you can arguably travel tomorrow or buy a purchase a home tomorrow, fantastic. Doesn't mean you have to, but it means you've got the door open so you can start that journey if you choose. So when you're ready, you're ready. As long as your circumstances don't change adversely, you can enter that property market sooner than you realise. And I would say a lot of first home buyers that I meet with are a lot closer than they realise. Very easy to believe the media, and we touched it on the heading before, that you can't buy your first house. Well, whether you think you can or you can't, you're probably right. But it costs you nothing other than time to find out what your options are.
But by the same token, a lot of those people, a lot of those first home buyers that feel that they're so far off from owning their first home, there is also some of those that are like, yeah, I'm fine. You know, I've got no issue. I'll get a loan tomorrow. You know, I got a job, whatever. And turns out, you know, that they were late on a Telstra bill or whatever it may be. I'm not singling out Telstra, right? Because I'm still waiting for their 5G coverage to come in. But just in general, like it's one of those things where you definitely, whether you think you can or you can't, you need to talk to someone to really establish where you sit and if there's anything you need to clean up or change, because banks also check your statements, don't they?
Some are more diligent than others. So some are like forensic accountants. So if you go away for the weekend, you come back, your wife's looking at your bank statement. What
go
are you
easy
doing?
on your withdrawals, basically.
So, but some don't. So there's certainly lenders that are better than others with that analysis of your bank account. Or, for example, let's say I bank with the Commonwealth Bank and that's where I go to do my loan. Well, obviously they can't unsee that because you bank there. So sometimes going for a loan where you bank with can be an advantage. Sometimes it can be a downside. It just depends what your bank statements are showing. But the post-Banking Royal Commission, there was a real pinpoint analysis of what's called living expenses. We know it as HEM, Household Expenditure Measure. Some lenders now, basically as long as we're declaring or your living expenses are declared over and above what they deem the HEM figure to be, they're typically okay with it, but they're absolutely within their rights to ask for it. Some lenders would have significant concerns with gambling. What's the reason behind it? Like, was it Melbourne Cup or whatever? Whereas if it's every week, they might just count that as an ongoing expense. But it's not quite as bad as most people think, but certainly there's some lenders that are worse than others.
Okay, so lenders, since we're on the gambling thing, so for anyone that needs to know, the sports bet or whatever accounts you've got, probably not super favourable if you love a punt. And Liquorland might not be the best.
Not by itself.
Do they categorise it?
Look, gambling's probably one that is a potential flag, but we've got to. If let's say you gambled $400 a month, we treat it as if it's a liability, like a car loan. Okay. Or if you gambled once a year at Melbourne Cup, whatever, you put $20 down, whatever. That's not a problem. That's very unlikely to cause an issue. It's like if you went to Macca's once a month and bought lunch. It's not going to be an issue, very unlikely to be an issue. But certainly some lenders are stricter than others. That's probably the best takeaway. And my job, or our job as a broker, is to know how to navigate you to that path. Much the same as a pilot on your plane when you're travelling. It's not to say we don't hit turbulence, because we do, but my job is to get you landing safely at your destination with what the information we have available.
Yep, fantastic. Let's talk about pre-approvals and the importance of pre-approvals. And are some of them not worth the paper they're written on?
Yeah, that's a great question. And look, in a hot market like it still is now, you're typically competing with multiple buyers. So the shorter and better your contract conditions are, the more favourable your contract is likely to be to a seller. So I think it's important to have a pre-approval in most cases. Now, it's important to note that not all lenders what's called validate pre-approvals. So not all pre-approvals are equal. So some lenders, for example, if I said you earned $1 million, their computer system would assume that is correct. It doesn't validate the information until there's a live contract on it, which means I could issue a pre-approval, probably assuming I'm correct, and you'd hope I would be, but until it's assessed with a live contract, that means the pre-approval could be withdrawn. Okay. So it's important to note that if you are doing a pre-approval, and your broker should know this, they will be able to get that a validated pre-approval for you. Some lenders will only validate pre-approvals if there's an auction and you're a registered bidder. So it depends on the lender. Some lenders say, we take 2 weeks to assess a pre-approval, but if it's a live contract, we do it in 5 days. Obviously, the big advantage of having a validated pre-approval, you're less likely to hit any unexpected hurdles. And then when you do have a live contract, it's typically a very quick process to activate that pre-approval and convert it to a full approval. If we're not increasing the loan amount, typically we don't need to get it re-credit assessed. It's a formality of getting the property valued and assuming there's nothing else outstanding, converting that to pre-approval. 5 to 7 days is a realistic time frame for that.
As an average for most lenders?
From when it's pre-approved to converting it to a full approval.
Okay.
So a week is typically enough. I would get 7 days just in case there's an off chance there's something else that they ask for to just updated statement or bank account or pay slip or something like that. But as a rule, there's typically nothing else asked when a pre-approval is being converted to full approval other than the valuation and the contract.
Yep, fantastic. Renting out a room. Now that there has been some changes recently in Queensland in regards to renting out a room to help with your payments as a first home buyer. Talk to us a little bit more about that.
So when I bought my first house, I was 22, which was a few years back now.
It's a couple of years ago.
More than 5 years ago. But I actually rented. I lived in one room and I rented the other rooms out, and that was how I could afford my mortgage. Under the prior government, the state Labor government, technically, if you rented a room out, you should declare that as income, and it would potentially make you ineligible for stamp duty waivers and grants because you were getting an income from a property. So the current government have changed it so that you can legally rent a room out and not make yourself at risk of being penalised for these grants and discounts that you've received, and you can do it. And there are some lenders that will also factor the board income in. So if I'm going to buy a house and it's a 4-bedroom, for example, and I'm going to rent the other 3 rooms out at, say, $150 a week, they'll let me take that income in, which can boost my serviceability. Not all lenders do that, of course. Some of them want a stat dec. Obviously, if I'm married, like I'm married, I've got 2 dependent children, I can't live in a 4-bedroom house and rent out the other 3 rooms. So it's got to make sense. And if I'm renting it out at $600 a week, but the market says, it's about $100 a week for that rent, well, the lender will work on the lower figure in that case. So even if you're, for example, renting it to a foreign student and you're getting $400 a week because you're feeding them as well, they'll just go on the market rent, not the actual rent you're getting in that case. But it's a really good way to boost your borrowing capacity. It doesn't restrict your lenders from mainstream lenders too much, and lenders like the Commonwealth Bank will factor that into account for servicing as well, and it's a really good way to increase your borrowing capacity and help you maintain your mortgage payments and still have a life of being able to go out for dinner and that kind of thing.
100%. So what's the minimum deposit needed to qualify for different schemes?
Sure, great question. So as a rule, you need a 5% deposit plus costs. So for a first home buyer in Queensland purchasing a property for $700,000, I would suggest at least $5,000 for on-road costs. Like when you buy a car, that you have your on-road costs. So if you're buying a house for $700,000 and you're paying cash, it'd probably cost you $705,000 by the time you've moved in. So as a rule of thumb, you'll need $35,000 in that case, or 5%, plus your costs, which would be another $5,000. So you need $40,000 to purchase your first home. Now, that's a tough thing to do. If you're renting as well, it can be tough to salvage or to get $40,000 together on top of living and paying all your bills. So that's where a parental guarantee can come in, because you can actually borrow, depending on the lender, 100% plus costs. It's better if you have some cost to contribute. So your $5,000 on road costs, for example, but you could potentially buy the house with little or no deposit, providing your income can support the loan, and mum and dad are happy to come on as a parental guarantee.
Definitely. And let's talk about getting into your home sooner. I think this is very, very important that people utilise LMI, the bank of mum and dad, their first homeowners grants, and whatever they can to get into the property, because the market is moving so quickly. While some people are struggling to save to their 40, there will be others that will be like, I want to save a good deposit so I can put a good deposit down on a property, and I want to save $150K and then put that. That does not work. So if anyone out there who needs to hear that doesn't work. Saving the large deposit to buy your first home is the worst thing you can do. You need to pay LMI, use the first homeowner scheme, do what you can do to get into the property as soon as possible. The property does the work.
Correct.
Property goes up in value.
That's right, because if you listen to some financial experts, they say you should have a 20% deposit, and you should if you can. But let's face it, in reality, if you're buying a house for $700,000, getting a 20% deposit on top of paying rent or car loan, whatever else you've got, is a difficult thing to do. So if you can get into the market, more than likely that property will grow in value faster than you can save that 20% deposit. So it's the opportunity cost of not buying.
Opportunity cost.
And I remember a guy who actually used to work for us, and he's an electrician. He's now in the mines. He does FIFO, but he was going to purchase near waterfront on the Gold Coast when he was pre-approved. When COVID hit, someone told him to hold off because the property market's going to crash. Now, they did end up purchasing 3 years later, but they bought just behind Dreamworld. That was how far back they went with the same budget, because they were waiting for the crash. Now, there may well be a property crash. I personally don't envisage that anytime soon. So, but if
there's going to be one.
When?
There's going to be. That's the question. Spot it. Nailed it. When? I don't know when. Does that mean we stop playing the property game? Because we could have another 2-3 cycles before it goes, right? So
correct. And we're in July now. I think there's 1, if not 2 more rate reductions to come, and as some schemes roll in on January 1 next year, I think that's going to put a bit of pressure on house prices as well. So if you're waiting for the market to crash, I think it's probably not the strategy I would advise. You could argue I have a vested interest in someone wanting to buy a property as a broker. But what I've seen in my experience is the best time to buy a property typically is yesterday, and if you didn't do it yesterday, well, today's the next best.
Yep.
As soon as you can get your foot in the door.
As soon as you can afford it.
More than likely that property will grow in value. Obviously, there's no guarantee, but there's not too many people who would have lost money in property in the last 4 or 5 years.
No, definitely not. So you touched on a couple of interest rate cuts there. I think we're due for 2 more this year.
I think 1, if not 2.
Yeah.
Is likely. Yeah.
And that's only going to continue to drive the market. What I'm seeing on the ground here in Brizzy is, 15, 20, 25 groups through an open house, wherever you go, from, right close to the city all the way to Eagleby. So based on that, there is a shortage of supply. There is no stock, right? But there is demand. So based on that, interest rate cuts give people more serviceability, make it more affordable. You are going to see more buyers in the market, and you're going to see a stronger market. You're going to see it move upwards with those cuts. So for those people, as we touched on earlier, looking at saving the big deposits and so on, don't. Just get into the market as soon as you can. Talk to a broker. Yeah,
it's a matter of finding the right strategy. So it's as I said before, the best time is yesterday, if not today.
Yeah.
So there's typically the sooner the better, but obviously it's a pretty big purchase you're likely to make, so you don't want to rush into it.
Yeah.
But unfortunately, in the current market, you probably don't have a significant luxury of being able to be – you can be choosy, but you don't have the luxury of going, well, I'll wait and see if this one goes. But it's important, I think, if you are thinking to look in the market, to engage a buyer's agent or be going to open homes so you can get an idea of what the market's doing, where you're looking to buy. Is it in your price range of what you're looking at?
100%. Now, talk to us about purchasing with a family member or a partner. So it could be a brother, sister, cousin. It could be your partner, fiance, whatever. If you are looking at purchasing something, how does that affect the scheme for them and yourself when you're...
So if you're using the home guarantee scheme, that's quite okay to do that. You both have to be eligible. So if you and I were buying a property, we're both first-time buyers, we're both under 700 grand, the purchase price, less than 700 grand, we're accessing the scheme business as usual. As a broker, I would probably suggest you have loan A, I have loan B, so we can keep our money separate. Just be mindful it doesn't stop you from seeing or accessing my loan and vice versa. There are a couple of lenders that do a product called property share, and that enables us to keep our loans completely separate. We have a line in the sand. I can't see or touch yours. You can't see or touch mine. Okay. And if we part ways, be it we're friends, we're a couple, whatever it is, it keeps that exit a bit cleaner, assuming we're amicable. Obviously, if it's not amicable, it's going to court and the judge will decide. But assuming things are amicable, you're kind of setting up that exit strategy in advance. Should you want to part ways, and that could be you and I as mates buy a property together. I then get married, our marriage busts up or whatever. You don't want your portion of the house to be potentially at risk. So that property share it still is at risk, but it minimises it somewhat because, as I say, our loans are completely separate. You can't see and touch mine. So it does put a bit of a protection mechanism in place for us. Should we part ways amicably, it makes things very, very easy.
Awesome. Okay.
Going back to the loan A and B, typically what I see as younger couples, the girls typically living out of home already, so they haven't got as much money, but they've got all the furniture. Typically the guy's still living with mum or dad, and they've got a deposit, but they don't own anything. So we might split the loan. So boyfriend might have a loan of $300,000 because he's got a greater deposit, whereas the girlfriend might have a loan of $400 grand because she's got less deposit because she's been out renting and that kind of thing. So we can split loan. It doesn't have to be 50-50. And again, that's purely about if you do part ways, which is a grim way to look at things, but
it is. But your solicitor would advise you to do it anyway, right?
Yeah, correct. So. And you can do things, so you can also have your property ownership in, for example, 90-10 or whatever, and there could be a number of reasons you do that. Obviously, we'd recommend you get advice on that. But there's a way you can potentially take advantage of the scheme. So let's say my partner and I are going to buy a property together. I'm a first-time buyer, she isn't, so I might put the property 90% in my name, 10% in her name. So I get a 90% exemption on the stamp duty. Yep. We pay the 10% stamp duty as normal on her percentage of ownership.
Yep, makes sense. Talk to us about buyer readiness. Now, 3 things a customer should know. So borrowing capacity, LVR, credit score. Talk to us about that.
Sure. Okay. Well, the first thing to note is a pre-approval typically has a shelf life of around 90 days. So once you're pre-approved, the clock's ticking. Doesn't mean you have to buy a house within 90 days. Chances are you can get another pre-approval if you need to, but just be mindful it's typically valid for 90 days. It's a good idea to know what what your income is and what your borrowing capacity is. Obviously, we know that if we're doing a pre-approval, and the same as the term LVR or loan to valuation ratio. So in other words, how much you're borrowing versus what the property's worth. That will determine whether we're using a scheme deal or a parental guarantee or whatever the circumstances are.
Yeah.
The other thing that's important, you'll see ads on social media, and I'm not a fan of these ads, but it says, they will go up to some random in the street, so do you know your credit score? To put it in perspective, let's say your credit score is 800 and mine's 700. We're going for a home loan, we're on identical. You're not getting a better home loan rate because your score is higher than mine. Personal loans can be potentially a little bit different based on the credit score, but credit scores are very much like when I look at my kids' report cards. As long as I'm not seeing anything bad, I don't really mind what's on there. I'm just looking for the bad stuff. Yeah. So the lenders are the same with credit reports. If you don't know what your credit score is and you are intrigued by one of those ads, please don't. My advice is to not use those. Go to a website called mycreditfile.com.au. It's a footprintless free credit check you can do. And if you'd like us to review it, we're more than happy to do it. It doesn't cost you anything, doesn't obligate you to do anything, but you can pull your report and see what your score is. It's important to note there's different components to a credit check as well, but the main thing we're looking for is bad stuff. But there's 3 different scores on a credit report as well. Some lenders use all 3, some only use one of them. So sometimes we'll choose a lender based on what your score tells us to use. But as a rule, if it's 650, 700 and above, it probably doesn't matter. Personally, I get my credit score every month. My score typically sits around 1,000. It doesn't mean I'm getting a better deal than you on a home loan. We're on an identical thing.
I just need you to co-sign this though.
Yeah, definitely. As I say, on a car loan or a personal loan, there could be a slight variance there. It's more relevant in that unsecured or that space, but in the bricks and mortar space, it really, unless it's bad, it really doesn't have much impact at all. If you've got defaults and that kind of thing, so let's say you moved house, you forgot to pay the electricity bill or the phone bill, that can be a problem, but it depends on the amount. What was the story behind it? Did you pay it? But if you had to have a default or electricity or phone bill would be the best one.
Yeah.
If you had to have one.
Yeah. Now, I'm a buyer's agent, but we want to talk about using a buyer's agent in this transaction. We obviously work with a lot of investors. We do work with first home buyers and we do work with owner occupiers. But tell me, in your experience, how have buyer's agents helped first home buyers? So
the big thing is, I would say from experience, is off-market properties. So that the hard part is you go to an open home and there's 30 people there and you're competing with that. If you can get a property that's off-market, that can potentially avoid a lot of that and potentially get a better price than what the price would otherwise be. Yeah. So that can be worth their weight in gold. But importantly, it can be just as simple as getting a property as first dibs, if you like, that meets your criteria. So it could be that I need a 4-bedroom house with a pool or whatever my criteria is. So you're doing that homework for me in that regard. So so that's probably the big thing, is that in a hot market like it is at the moment, could be that I'm incredibly time poor and I just can't get to open homes, or maybe I'm living interstate, I'm going to move to Brisbane, so I need you to go and this is the house I'm looking for. I guess there could be any number of reasons, but I dare say if you're a buyer's agent, you probably want someone pre-approved. You don't want to find a property and then find they can't get a mortgage for whatever reason.
Definitely, but as a buyer's agent, sorry to chime in there,
sure.
I don't want anyone coming in with no pre-approval and signing up with us and paying us an engagement fee and then they can't purchase. That's obviously not a good way to conduct business. Sure. We want to make sure that they can get the loan for the property that they want to get. So we always advise to work with one of our approved brokers. It's incredibly important to ensure that you know what you can buy and that you can buy it, not just place properties under contract.
Sure.
And then have the drama of them falling over, right?
Yeah, and my first exposure to a buyer's agent, I remember back in the early 90s, I was working at Suncorp, and there was an executive moving from Sydney to Brisbane and he engaged a buyer's agent to find him a house. It had to be within so many kilometres of the office in Brisbane CBD, had to have a pool, had to have so many bedrooms. And I was like, wow, that's really interesting. But and I remember chatting with him about it, and he was like, well, I didn't have time to fly up and look at property each weekend. So I engaged a buyer's agent to shortlist those properties for me. Yep. So I think definitely the focus was traditionally gone away a little bit from, I'm a time poor executive and I want to buy a property because I'm moving interstate on $1 squillion a year, to now I need the help to help me get into that market. So what you want to have in your ammunition belt, if you like, as a prospective buyer is the ability, you want to be pre-approved, I think, to make your offer stronger. And if you can have a buyer's agent on your side, they're doing some of that negotiation for you. Which
the buyer's agent brings credibility.
Which I think gives you, it's like having a stronger resume. And if you're in a multi-bid situation, if I'm an agent and I'm talking to you as a buyer's agent versus first home buyers who aren't quite sure what they're doing, I don't know, I've got to go and check with this guy, whereas you're a much more confident applicant, if you like. It's like if you're looking at a resume for someone, you might shortlist those based on certain criteria. So I think having a buyer's agent definitely can make you a stronger candidate, especially in a multi-bid situation.
Yeah, we win 9 out of 10 times when we're negotiating against the general public or, when it's in a multiple offer scenario, because I'll know how to speak with the agent. I know how to build rapport, and because I'm a long-serving buyer's agent, I've been here 11 years, when I speak to them, and if my client really wants property, I'll make sure that they get it. The thing is, where I find the best deals are the ones where because I don't like the competition, because competition is great for the seller. The competition is not great for the buyer. The buyer's agent's game has changed a lot. 10 years ago, we used to look for off-market deals, and we still look for off-market deals, but the buyer's agent was to find you something undervalued, like an absolute bargain, and it's like you've got 10% under market value, and you're running in with instant equity. You pay the buyer's agent, you make some profit on the way in. Now people are using me to just get ahead of the other 10 or 20 people. And quite often, in a multiple offer scenario, I will beat the other competitors, but I will look to avoid that. That's why I don't work Saturdays. I don't go to auctions, because I don't want to compete. Competition is me losing. That's how I see it.
Sure.
So as a buyer's agent, when my first home buyer or investor or whoever comes to work with me, I want to try and find the off-market deals through my network of contacts that give us an advantage. They're a good price, and we get in cheap.
And I guess it goes back to that travel analogy. If we're going to Japan, you're my translator.
Yeah.
So you can help me negotiate and liaise with that person in that regards. So very much what we do as a broker, very much what your conveyancer will do, and having that team behind you to move that transaction through so when on settlement day you're getting the keys and it's all yours.
Yep, 100%. So let's say someone engages a mortgage broker to the point of settlement. How long does that roughly take a lot of your clients?
It really depends on the state and how hot the market is, I guess, and it's kind of like a car. We'll drive it as fast as you like within reason. 30 to 40 days, very common woe to go. So you sign a contract last weekend. Hopefully by today, if not, we're Tuesday today, so by Tuesday, if not Wednesday, we've got the application in, if not already, and we're rolling in that process. If we're pre-approved, we're waiting for the valuation to come back to activate the pre-approval, and that's generally a 3-day process, so relatively quick and easy in that regards. I guess from a pre-approval, that's certainly work, but when your offer's accepted is when our work really begins. Now, your conveyancer is like your traffic controller, and they're going to guide all the parties into settlement, the seller, their bank, you as the buyer, whoever the lender we're using for your situation is, and they're going to make sure the right amount of money is handed over to the seller and the agent and whoever's got to be paid to make sure that works for them. So that very much the conveyancer takes over from unconditional, and if you like, air traffic controller, they're going to guide everyone into safety so they can make sure the settlement occurs on time or as close as possible, and the right amount of money is paid to the seller and the agent and whoever's got to be paid, basically.
Yep, and the keys are yours.
That's spot on.
Fantastic. So now that we've got a loan and we've purchased our home, what are some of the things we can do to pay off our home sooner, to pay for, to down pay our loan faster?
Sure. Look, it's a great question. So let's say your loan settles on the 1st of August. Technically, the first payment typically isn't due till the 1st of September. So a lot of people make the mistake, in my opinion, of waiting till the 1st of September to make their first repayment, which means you're already behind the 8 ball because you've got your loan plus 1 month of full interest. So my advice is to start making repayments as fast as practical to the loan. So if you're paid weekly, my advice would be to pay your loan weekly and try and round it up. So if your payment's $680 a week, maybe consider paying $700 a week. Unless you're on a fixed rate, as a rule of thumb, you can redraw those surplus funds. So let's say you wanted to get all those $20 extra a week you've paid off and the hot water system blew up or whatever, you could redraw that back. Typically it's free. It might take 24 hours depending on your lender, and or you can utilise an offset account. Just be mindful with an offset account. Some lenders charge a higher interest rate and or fee. That's horses for courses. Whether you should have an offset, it depends. If it comes free, you might
offset
use it.
Versus redraw is a common thing that we all discuss.
100%.
Now, what side of the fence do you sit on?
So I live on acreage. I can't imagine a circumstance where I would rent my house out. So I've been around 35 years. I don't have an offset on my own loan. If there was a secret an offset was going to guarantee me super fast payments, well, I would use it. I don't get paid better or worse. I've got no advantage in it. But the lender I have my loan with doesn't even have an offset account. If it came with it for free, I would use it. But my nationality or many generations is Scottish, so I don't like paying money that I don't need to. So in my opinion, if I was going to make my house a rental, critically, almost certainly I would have an offset account linked to it. I'd make my surplus payments via the offset and I could access those funds if and as I see fit. But it depends on your circumstances. There's never a time where an offset is always better. because if the rate's high or the fees are higher, well, maybe and you don't need it, it's not necessarily better. I've got clients who've had poor experiences with tenants before. They will never go down the rental path again.
Yeah.
So in which case, if an offset's there, great, use it. But would you consider paying extra for it? That could just be a preference. To give you an idea, it might be a fee of $395 a year versus no ongoing fees. So you might go, well, gee, it's only $400. I'll just pay it and I've got it. And it's kind of like if you're going to build a high-rise building, when should you put your underground car parks in? Probably before there's a building on top of it. So if you get your structure right, it'll pay for itself in the long run. So if you said, look, I'm buying my first house out at Laidley, but I'm only going to stay there for 6 or 12 months and then I'm going to move out and make it a rental, almost certainly I'd be recommending an offset account for you to park your surplus funds, because then you can pull them back later should you make it a rental without any tax implications.
Yeah, fantastic.
So it always depends on your circumstances.
Exactly. So, Scotty, when people are out there now thinking they've watched this podcast and or listened to the podcast and they're like, well, I need to go find a broker, what are your top tips for finding a good mortgage broker?
So, personally, a good place to start is your local Facebook groups. I mean, we're more than happy to help you, but if you want, you might say, well, look, I live in Toowoomba, I want to use someone local to there. But your local community Facebook groups are often a good place to start. In my opinion, I would be using a free service broker. Brokers are legally allowed to charge fees. Personally, we don't. We get paid by the relevant lender, but some brokers charge fees, but they must provide a credit quote if they're going to do that. They can't just hit you with a bill, by the way. Oh, by the way, you owe me $1,000 or whatever. So personally, I think a free service broker is the way to go. And if you don't know one, ask family and friends for a recommendation. Look at Google reviews. We have over 200, but ask your local Facebook groups and that kind of thing. Geography isn't a big deal with brokers nowadays, especially post-COVID. Zoom and Teams are very normal for meetings. I recommend sitting down with a broker if you can. It depends on your circumstances. You may be time poor. It just can be any number of reasons. But it's kind of like if I'm describing a haircut, what I'm describing and what you're picturing could be two different things. So by sitting down, we're kind of all on the same page. We know exactly where we stand, especially if you're using a parental guarantee. I think parents get a lot more comfort when they've eyeballed me as a broker. They just get a bit more comfort as to they know what it really means to them to have that guarantee in place for that first 20% of the loan. No,
that's fantastic. Scotty, thank you so much for joining us today. Tell me, for anyone out there that is listening, watching, how do they get in touch with you?
You're welcome to or message me through you.
Yep.
You can visit our website, cubeloans.com.au. It's a free call. If you'd like to contact us, you can call 1-800-774-756.
Does it spell cubed?
It doesn't. We used to have back in technology. We used to have a number you could text the word 13 cube to 13 text, and it would call us.
There you go.
And that they never got a big take up on it, so we lost it unfortunately.
No,
but I think we had like 4 people use it in 4 years. It was I think it cost us $30 a month or something.
Yeah.
But it was a. My mum and I thought it was really cool, but not too many customers. That was a bit of a fun thing we've had. But I think you've got to, like for me, first home buyers, my absolute favourite market. It's really personally satisfying, especially if they've been told no. It's something I really, even 35 years in, I still get a lot of satisfaction in. My eldest son is nearly 27. I'm encouraging him to try and get into the market.
Yeah.
He probably needs to go and see another broker because he's not going to listen to me as his dad. But it's a matter of getting that path in place so you can start the process. That's probably the number one thing. Find out what you know and don't know so you know whether you can or can't. And if not now, when? Yep. What's the path to get to there? I have a saying with my clients, I never say no, but sometimes I say not yet.
Yeah. And I think that's the important part, to go see a broker as soon as possible so you can put in place that plan for that purchase, which might be in 3 months, it might be in 6 months, but at least now you know you've got a plan moving forward, where you're going and how to execute that. But
absolutely.
But yeah, Scotty, thank you so much for joining us.
Thank you for having me.
I appreciate it, buddy. Thank you so much for joining us on this episode of Property Banter with Scott Beattie from Cube Home Loans. If you enjoyed this and you got a lot out of it, please like, subscribe, and share it with a friend. Share it with someone who could utilize this information who is a first home buyer. Until next time, take care.